Hey guys, real quickly, just before you listen to this episode, I want you to know that this is going to be a two-part episode. So you're getting the first part now. The second part is going to come out next week. So make sure you come back for the second episode. And this is going to be so good, especially if you're a woman physician who wants to learn tax strategy. You want to understand how you can stop paying so much money legally in taxes. This episode is for you, whether you're W-2, whether you own your own practice, you own your own business, as long as you're a physician who is tired of literally like working 2 days, almost 2 days a week for taxes only. You don't want to miss this episode. So make sure you listen, take notes, and you will learn how you can reach out to the CPA if you want to learn more about how you can work together. But just know this is a two-part episode, and you will be glad that you listened and watched. Enjoy the episode. So we're back with another episode, and this episode is going to be like honest and truthful because I'm sitting down here with an amazing CPA and tax strategist, and she has two, audacious claims that I can tell you all about. Number one is she believes too many physicians are paying way too much in taxes. And she also believes that we are shooting ourselves in the foot because we're not doing good tax strategy and tax planning. And so we all come crying in the spring because we're like, how come I'm earning $10 and I've only got $3 left? And the IRS is like on my back. So this conversation is not for y'all, but y'all are going to be listening in. But it's for me and Natasha Dornbush, who is going to be chatting with us about how she can help women physicians like you and I stop losing all of our hard-earned money to the IRS. Yes, I said it. We're losing money to the IRS. So welcome, Natasha.
Thanks for having me, Dr. Latifat. Glad to be on here.
So let me ask you, because you've been doing this for many, many years now. And so you've worked with hundreds of physicians and humans at this point. Mm-hmm. What are some of the most common mistakes that you are seeing physicians make, even in 2025? Like someone comes in from their old CPA, they come to Natasha and you're like, oh my goodness, this happens all the time. What are those things that you're seeing?
I think one of the main things is focusing on a refund and thinking it's a good thing.
Okay. Okay, tell us about that.
I know that sounds kind of whack.
Because people are celebrating their refund.
Yep, celebrating their refunds. That is whack, like you said.
Tell me why that is whack.
So how it works, and one of the first things I always do when I meet with a client for the first time is ask them how much they paid in taxes. Typically, they can't give me that answer, but they tell me, but I got a refund. Or they will tell me how much they paid after they filed their taxes. Like your CPA prepared your taxes and they told you this is how much you owe. What they don't realize is that is not how much you paid.
Okay.
Right? There's a line on your return that is called the tax liability. That is the number that tells you how much you paid. Doesn't matter if you got $100,000 back in a refund. If that line says $200,000, that's how much you paid. Right? So if that line says $200,000, you got a refund of $100,000, that means you just overpaid. You paid the IRS during the year, you paid them $300,000 when you should have paid them $200,000, and they just giving you your money back.
All right, she came out swinging. She's like, all y'all that are celebrating your refunds, you just got part of your money back. This is not something to celebrate because it's incomplete data. You don't know if you don't know how much you paid in taxes, not how much you owe, but how much your tax liability is, how much. So that's the main thing you care about, how much we paid, not how much we owe or how much we got back.
Yeah, the flip side of that is when I ask them how much they paid in taxes, they will tell me, I paid $100,000, right? After they file their tax return. And then when I look at that liability line, it says $400,000. I'm like, you paid $500,000, not $100,000.
Okay, when you look.
If your tax liability says $500,000 and you only paid in $400,000 during the year, that $100,000 extra that you paid is not how much you paid in taxes. You paid $500,000.
Okay. So we want to know what our tax liability is.
You got to know what your tax liability is.
I can tell that definitely of course, you're kind and sweet and nice and all of that amazing stuff. You're so sweet and kind and generous that you're one of our sponsors for our in-person event. But at the same time, you're like, I can tell that this is something that you expect will happen already when people are coming in. What else? Tell us the number two thing that you're like, this, you sure? I already know it's going to happen because everybody in their mama be doing this.
Number two is deducting them scrubs, man. The scrubs.
Okay, why are you pulling
I mean, I always say that jokingly because, yes, even if you're a business owner, say you're a locum physician or something, yes, you get to deduct the scrubs, but the scrubs is not going to move the needle on a $300,000 tax bill. You know, don't focus on these little deductions that don't move the needle, right?
Okay.
Don't focus on those things. You gotta put yourself in a position where you're working with someone that will actually present strategy, not deductions, but strategy that will help you move the needle on those taxes, because you ain't paying $400,000 for a scrub, right? No.
So far, scrubs maybe like $1,000 max, so like a couple of scrubs. Okay, so strategy, not deduction. Tell us a little bit more about that, because most times when you hear about tax, people are like, oh, deductions, given, and all of that. And I know that can help with something.
Yeah. I mean, those things add up. They add up, but they don't move the needle, right? There are deductions, substantial deductions, like charitable deductions and things of that nature. Yes, but what you need to focus on is finding things like money you're already spending. Because people are like, okay, what can I buy before the end of the year? I'm like, no, that's not what you need to focus on, right? You need to focus on things that they're advanced strategies, right? It's not, I mean, some of the go-tos are like retirement plans. Those things are all good, but it depends on the retirement plan that you select, because some of it is really deferring your taxes. So you get that write-off this year, but when you take that money out after you retire, you're going to get hit with the taxes. So it's a deferment, which is good also, but you have to know what you're doing. Know that it's tax savings in the year that you do the contribution, but when you take it out, you're going to pay those taxes, right? There are different types of retirement contributions as well, where you pay the taxes up front and then you contribute that and it grows tax-free, right? The thing is, you got to understand what you're doing and what the consequences, what the benefits and the advantages and disadvantages of every move you make. But you got to be strategic, right? Saving taxes is not about deductions. It's about being strategic and doing things that are in line with your lifestyle, right? Things you're already doing that are not currently, like income you're making that is currently in a taxable situation. How do we move that income and structure it in such a way that it becomes non-taxable, right? Things you're already spending that are currently not deductible. How can we move those things that are currently, you're already spending the money, right? How can we move those things, right, from being non-deductible into being deductible? That's step one. That's step one. Money you're already spending, not go and buy a car at the end of the year. That's another one. Not saying that those things don't work, but it's strategy, right? Maybe you should buy a car, but don't buy a car just to save on taxes.
Yeah, that's like buying a bad property just to save on taxes.
Exactly. If you are already wanting to buy a car or needing a car, absolutely, right? But it's and that's another thing. It's a business deduction. There's certain criteria that you have to meet to actually qualify for the deduction, because people go buying cars and they can't even take the deduction because they don't meet the criteria.
Have you had that happen?
Oh, I'm upfront with my clients about that. Like, before we go into it, I tell them all of the risks associated with this. If you don't do this, you don't get the deduction. And because we work with each other throughout the year, we have these checkpoints. So I make sure they're doing the things they need to do so they won't get disqualified from the deduction. Because you know what? At the end of the year, when I'm doing the tax return, if they don't meet that criteria, guess what? They don't get the deduction. Complete waste of you even doing the strategy, because one little mistake could throw everything off, right? And the mentality you have to have is what I call strategy stacking. There's so many different things that you can do. But the question is, what is the optimal mix? So if I were working with, a new client, I would be trying to see what is the optimal mix of strategies for you specifically. I don't care what other doctor friend does, like for you specifically. Because many times too, what works for one person doesn't work for the other, right? That person meets criteria that you have no clue they meet. Unless you have an expert to go in and drill down into your unique situation, you will never know, because I've seen people do things thinking they got the deduction and they didn't. I am upfront with my clients about that, because they need to understand you need to do the things to get the deduction, and you need to be more conscientious about it, right? I will let them know. Most professionals would just prepare the return and don't say a word. But I want my clients to understand whatever you're doing, how it impacts your taxes. If you didn't get it right this year, you get it right next year,
So I kind of warned them, but you came out throwing punches. And we recorded this on a Friday.
Well, it really takes a mindset shift, especially if you've not swam in these waters before, right? Don't focus on that refund and the scrubs. Don't focus on what can I buy before December 31st to get a deduction. That's not strategy. That's just picking random things and seeing if it'll stick, right? And most of the time, those things don't move the needle. It's those very strategic advanced strategies that would actually move the needle on your tax liability.
Tax liability. That liability line is what you want to get down, y'all. Okay. And I loved that you said, stop. Deductions can be helpful.
Yes.
But they don't move. They shift them, but they don't move. Is that what you said? Or was it the opposite?
They don't move the needle.
They don't move the needle.
Yeah.
The strategy is the way that, and I love how you're saying it, because what comes to mind is almost like, deductions can shift things a little bit, but if you want to go from one place and move to a different place, you need strategy. Like, yes. What is the strategy where we have a building, we want to move the building to a different location? What is the strategy?
What is the strategy? What is the tax impact?
Okay.
Don't think, what can I deduct? I tell people, I will tell you that for free. Because it doesn't, I can tell you that for free because it doesn't really move the needle. You will get some, don't get me wrong, you will get some benefit out of some regular business deductions, but they don't move the needle on a $100,000, $200,000 tax bill. They don't.
Okay. We get it now. So let me ask you though, we're talking about strategy, maybe this is a myth, and I'll have you unpack this for us. Many times people say that deductions and strategies don't really belong to physicians that are W-2. Is that correct or is that incorrect? Or, tell us about that. Are W-2 doctors doomed forever?
No, they're not doomed forever. Do they have less opportunity for those larger, more impactful strategies? Yes, but they do have the ability to take advantage of some other strategies. They're advanced strategies. They're not going to, like I said, it's not going to be scrubs. It's not going to be things like that, but there are some advanced tax strategies that W-2 earners can benefit as well. They're more investment type strategies, but they can benefit from them.
Got it. So let me picture right now, and I know, again, you've worked with so many physicians. Let's just walk through. And of course, guys, we're not your CPA. We don't know your situation. This is like a case discussion in med school we're having right now. We ain't your doctor. We ain't your doctor.
I am a CPA, but I'm not your CPA. That's if you're not one of my clients. If you're one of my clients, then
call her.
But if you're listening, and I'm not your CPA, I am a CPA, not your CPA.
So like you broke up with us on live television. Okay, all right. So a random doctor comes to you. What are some of the W-2 doctor? What are some potential? Because there's some people here that maybe they're doing a TurboTax, or maybe they have their own tax person. They're looking, but what are some examples of things that W-2 doctors you've helped them do. Again, this is all theoretical, of course.
Mhm. So one of the main things would be investment type strategies.
Okay.
That's where they will shine mostly, right? I always tell them, during the year as you move through the year, and that's why one of the reasons why I always encourage people to start strategy at the beginning of the year is you got to make sure that you plan for this so you could actually make the investments. Because if you're cash strapped, you won't be able to participate in these things, right? So make sure you plan for it. If you have the extra cash, some people just have it, right? The extra cash laying around and they're able to do it. But especially when you're just starting out, it's your first year, and you're going to get first year with that high income and you're going to get hit and you just spending like, you're spending it as it comes in. And with W-2 income too, it's a little more difficult because those withholding taxes, right? As a business owner, you get that cash and you kind of tell it where to go, right? With the W-2 income, they have to do the withholding and things of that nature. So what comes, into your checking account or your bank account when you get paid is after all of the tax. So you have to make sure that your cash flow, right, remains pretty healthy. So if you have the opportunity to make an investment, like a tax efficient investment at the end of the year, you're not scrambling at the end of the year to do that because you planned, you have a strategy of exactly what you're going to do, when you're going to do it, how you're going to do it. So one of them would be, there are quite a few, but the asset-based type strategies, like real estate, investing in real estate, there are a few other ways you can do that. There are more risky investments, asset-based investments that you can invest in, not necessarily real estate, but equipment type things. And there's oil and gas. And there's several other investment type strategies that you can do. But you have to meet certain criteria, right? Before I would even present them to you. Like you have to reach certain income levels and things of that nature. I wouldn't even present it to you. But most physicians usually meet that criteria. Usually first year out of residency may be a little difficult, but by the second year, you're pretty much able to participate in those types of tax.
Is that because they have to be accredited investors?
Yes, you have to be accredited. So, and that's a 2-year journey, as you know, unless you have assets already, like in $1 million in assets, that you've had for the past 2 years, then you have to qualify, based on your income for the last 2 years.
So I know you've mentioned this word a couple of times, and I think it's because there is an algorithm in your head.
So what is that? Tell me what the algorithm is so I can tap into
We're
it.
about to get it out of your head though. But you said a couple of times that they have to be asset-based, and you emphasize, I love assets. It's one of my love languages.
Oh, really? Okay.
I love assets. I love.
That's why
I love assets. Literally, that's when people come to me. When women come, they're like, oh yeah, I've been told that if I pay off all of my debt, I will be free. If I save, I'm like, yo, no, saving and debt hyperfocus is not how you become free. Assets is how you become free. So you were screaming my love language multiple times, but I don't think it's because of me. I think it's because you have like an algorithm in your head. So why are you emphasizing asset-based? Because you did that multiple times.
Okay, so 2 reasons. Of course, when you invest in an asset, there's risk associated with it. But if you're careful, with the risks that you take, the asset produces income for you, right? Make money while you sleep. Remember that? Right? The other thing is, when it comes to tax strategy, depending on the asset that you purchase or the asset that you invest in addition to that income producing that it does, there are tax benefits associated with it as well if you structure it right? Very, very generous tax benefits. So if you combine the income producing aspect of it and the tax benefit, that widens that cash flow so much more, right? So if you purchase the asset and the asset produces 100,000, 200,000, 300,000, but you didn't structure it right, you start at 300. But if you structure it right, okay, this is the income produced inside, right? We're at 300,000. But if you structure it right, and you, for tax purposes, then you save 100,000, 200,000, 300,000, 600,000.
I love it. Talking about cash flow on a Friday. So thank you.
So it frees up your, but see, the problem is you get the income benefits, but most people don't focus on the tax side. It's stacking on top of the revenue that you're producing. Yeah, it's stacking. It's like an automatic increase if you were to implement those things.
Okay.
Yeah.
So so here's the deal. I'm getting my questions based on what you're accentuating, because the next thing you accentuated was structure it correctly.
Yes.
What does that mean to our audience?
So for every tax strategy, there's specific criteria that you have to meet. Very, very specific. And if you don't meet them, even though you could have, you don't get the deduction, right? There's documentation, there's timing of when you do certain things concerning the asset. You've got to do this by such and such a date. If you do it after that, it's disqualified. Like, there's certain timing restrictions and documentation that you have to do in order to qualify for the strategy. And you have to meet all of the guidelines, laid out by the IRS for you to qualify for that. And that's what I help clients do. I make sure, okay, you did this investment. Does it meet this criteria, that criteria? Before you even invest, with making sure it meets all of these criterias. Because a lot of things may sound similar, like the investment. Well, I'm buying a house. If I'm buying a house and she bought a house and she got the deduction, then I'm going to get the deduction. No, it does not work that way. There's so much more fine print, because I always say when it comes to the IRS, there's the rule, and then there's the exception to the rule, and there's the exception to the exception, and then there's the exception to the exception to the exception. So it's drilling down into all of that to make sure that at the end of the day, when you do this, you're going to get that deduction is going to land on the return. Because if it doesn't land on your tax return, then you did it in vain. But you did it thinking you were going to get a deduction, and you didn't.
We're talking about W-2 physicians right now, because those are the people that are more like, well, there isn't much I can do. I am the stepchild. I'm a step of the stepchildren when it comes to IRS. Ain't nobody care about me. I can't even deduct my scrubs, right? So forget strategy. I can't even deduct nothing, right? My hospital pays for my jacked up scrubs with a limit of $200, whatever. So what you're essentially, let me ask you this point blank. Do you think for a W-2 physician, is it still worth it to have tax planning and have someone do your tax planning as a W-2 physician?
Yes, especially if you're a visionary.
Tell me about that.
So if you have aspirations or plans of, I have some physicians that come to me. One comes to mind right now. Her name is Dr. Nicole. And when she came to me, she was a W-2 employee, but she had aspirations to do consulting with hospitals. And she had aspirations to do consulting in other areas. And we spoke about it, and I explained just what I explained to you. You're W-2, right? Right now, you're limited by what you can do. But based on what you're telling me, let's plan for that now. Because a lot of those, if you have the vision for it and you want to execute it, then let's do it. Let's plan for it. So because the transition from W-2 to 1099, that's a whole...
Yeah. And you wrote a whole book about it.
Yeah, that's a whole other, discussion. But if you're a visionary, then I think you should have tax planning. One, at least do a diagnostic of your tax situation, particularly if you have investments and properties and things of that nature. Do a diagnostic, to begin with. If you have aspirations of doing consulting, do a diagnostic to see if you did consulting, what would your tax situation look like? Making the exact same amount of money. Because when you realize the tax benefits associated with it, yes, it's a vision that, you have aspirations and goals. You might speed that up a little faster.
You might speed that up. Yes, yes. The 10-year plan becomes your 1.5-year plan.
Exactly.
Yeah.
Because strategy is not a once a year thing. It's more of a long term. Like a lot of times when I do strategy for clients, we have phase 1, phase 2, phase 3, right? These are the things that we could do immediately. These are the things we should look at next year, because it's crafted for you specifically, your specific goals, your lifestyle, the things you want to accomplish. We're not just throwing strategies just for the sake of saving on taxes. Yes, I've had situations where I would present an opportunity, a tax savings opportunity, and, client decides, I want to do that. Even though I'm saving $100,000 in taxes, I don't want to do, but at least I know what I'm foregoing. Right? At least I know what I'm foregoing. I make this decision. Let's do this next year. Not a problem. If you're a visionary and you have goals and aspirations to step into business, to open your own practice, I think it's worth to at least do a diagnostic and have tax planning done as well for the asset-based type strategies that you would be entitled to.
All right. So good.
Does that make sense?
It makes a lot of sense. And when you're saying diagnostic, just so there's no confusion, what do you mean by diagnostic? You mean like a sit down in consultation? Tell us what happens during a diagnostic.